Question 1. The risk matrix shows a high probability of a client's long-term care needs impacting their estate plan and requiring specialized financial strategies. The client expresses confusion about how their existing will and trust documents will accommodate potential long-term care expenses and asks for specific advice on modifying these legal instruments. The client also inquires about the best type of medical care facility for their specific but undiagnosed cognitive decline. What is the most appropriate course of action for the CLTC professional in this situation? Option A. Advise the client to consult their current financial advisor for investment strategies and to speak with their primary care physician about their cognitive concerns, without further CLTC professional involvement in the referral process. Option B. Offer to draft amendments to the client's trust documents to address long-term care funding and provide a personal opinion on the most suitable medical care facility based on the client's description of symptoms. Option C. Provide the client with general information on how long-term care costs can affect estates and suggest they research different types of medical facilities based on online reviews. Option D. Refer the client to a qualified estate planning attorney to review and advise on their legal documents, and to a licensed healthcare provider or geriatric care manager to assess their medical needs and recommend appropriate care facilities. The correct answer is D. Refer the client to a qualified estate planning attorney to review and advise on their legal documents, and to a licensed healthcare provider or geriatric care manager to assess their medical needs and recommend appropriate care facilities. Explanation. This scenario presents a professional challenge because it requires a CLTC professional to navigate the complex interplay between financial planning, legal considerations, and healthcare needs, all while adhering to strict ethical and regulatory boundaries. The CLTC professional must recognize their limitations and the expertise of other professionals, ensuring that client interests are paramount and that no unauthorized practice of law or medicine occurs. Careful judgment is required to identify when to involve other professionals and how to collaborate effectively without overstepping boundaries. The correct approach involves proactively identifying the need for legal and healthcare expertise and initiating a referral process. This demonstrates a commitment to comprehensive client care by ensuring that all aspects of the client's long-term care plan are addressed by qualified professionals. This approach aligns with ethical obligations to act in the client's best interest and to maintain professional competence, which includes knowing when to seek assistance from others. Regulatory frameworks for financial professionals often emphasize the importance of client referrals to other licensed professionals when specific expertise is required, preventing the CLTC professional from providing advice outside their scope of practice. An incorrect approach of attempting to provide legal advice on estate planning documents, such as wills or trusts, is a direct violation of regulations prohibiting the unauthorized practice of law. Attorneys are licensed and regulated to provide such advice, and a CLTC professional lacks the necessary legal qualifications and licensure. Similarly, offering medical opinions or diagnoses regarding a client's health status or prognosis constitutes the unauthorized practice of medicine, which is strictly regulated and reserved for licensed healthcare providers. Failing to involve a financial advisor when complex investment or insurance strategies are needed for funding long-term care could lead to suboptimal financial outcomes for the client, potentially breaching fiduciary duties or standards of care. The professional decision-making process for similar situations should involve a thorough assessment of the client's needs, identifying areas where the CLTC professional's expertise is insufficient, and recognizing the distinct roles and responsibilities of attorneys, financial advisors, and healthcare providers. The CLTC professional should then initiate appropriate referrals, clearly communicating to the client the purpose of the referral and the expertise of the other professional. Maintaining open communication and collaboration with these professionals, while respecting their domains, ensures a holistic and compliant approach to long-term care planning. Question 2. Quality control measures reveal that a CLTC professional is assessing an individual's potential need for long-term care. Which of the following assessment strategies best aligns with regulatory expectations for comprehensive risk identification? Option A. Relying on general demographic data and common statistics about the prevalence of long-term care needs among different age groups. Option B. Evaluating the individual's current income and savings to determine their immediate ability to pay for potential future care. Option C. conducting a broad assessment that includes family health history, lifestyle factors, cognitive function, current functional abilities, and projected future healthcare costs. Option D, focusing primarily on the individual's current diagnosed chronic illnesses and their immediate impact on daily living activities. The correct answer is D, focusing primarily on the individual's current diagnosed chronic illnesses and their immediate impact on daily living activities. Explanation: this scenario presents a professional challenge because accurately assessing an individual's need for long-term care, LTC, involves navigating a complex interplay of personal circumstances, health status, and financial considerations, all within the framework of regulatory guidelines designed to protect consumers. The CLTC designation implies a commitment to ethical and informed client guidance, making the accurate identification of LTC needs paramount. The challenge lies in moving beyond superficial assessments to a nuanced understanding that anticipates future needs and potential financial burdens. The correct approach involves a comprehensive, individualized assessment that considers a broad spectrum of risk factors. This includes not only current health conditions and functional limitations, but also family history, lifestyle choices, cognitive status, and existing financial resources. This holistic view allows for more accurate prediction of future LTC needs and the associated costs. Regulatory frameworks, such as those governing insurance and financial advice, emphasize the importance of suitability and client best interests. Therefore, an approach that prioritizes a thorough, personalized risk assessment aligns with the ethical obligation to provide advice that is tailored to the client's unique situation and potential future needs, ensuring they are adequately prepared for potential LTC expenses. An incorrect approach that focuses solely on current health status fails to account for the progressive nature of many chronic conditions and the potential for future decline. This overlooks the proactive planning aspect of LTC, which is a core tenet of responsible financial and insurance advice. Ethically, this is a failure to adequately inform and prepare the client for foreseeable risks. Another incorrect approach that prioritizes only immediate financial capacity without considering potential future LTC costs is also problematic. Financial feasibility is crucial. It must be balanced against the likelihood and cost of future care needs. Ignoring these potential future expenses, even if the client appears financially stable in the present, can lead to a situation where the client is unable to afford necessary care down the line, violating the principle of acting in the client's best interest. Finally, an approach that relies on generalized assumptions about who needs LTC without individualizing the assessment is insufficient. LTC needs are highly personal. Generic assumptions can lead to underestimation or overestimation of needs, resulting in either inadequate planning or unnecessary financial strain. This lack of personalization is a failure to meet the client's specific circumstances and potential future requirements, which is a cornerstone of professional responsibility in this field. The professional decision-making process for similar situations should involve a structured, client-centric approach. This begins with understanding the client's current health, family history, and lifestyle. It then progresses to exploring their financial situation, including assets, income, and existing insurance. Crucially, it involves educating the client about the potential costs and types of LTC services. The assessment should then synthesize this information to identify specific risk factors that increase the likelihood of needing LTC and the potential financial impact. This leads to a personalized recommendation for planning strategies, always prioritizing the client's well-being and long-term security. Question 3. Benchmark analysis indicates that a client, a wartime veteran, is concerned about the rising costs of long-term care and has expressed a strong preference for purchasing a specific long-term care insurance policy they saw advertised. The client has not yet explored potential VA benefits for long-term care. What is the most ethically and regulatorily sound approach for the advisor? Option A. Thoroughly explain the eligibility requirements for VA aid and attendance benefits. Discuss how these benefits might apply to the client's situation, and explore all other available long-term care funding options, including private insurance, before recommending any specific product. Option B. Immediately recommend the long-term care insurance policy the client saw advertised, as this is what the client explicitly requested. Option C. Advise the client to immediately begin incurring significant, non-essential expenses to reduce their countable assets in anticipation of qualifying for VA benefits. Option D. Inform the client that VA benefits are generally not sufficient for comprehensive long-term care and focus solely on private insurance solutions. The correct answer is A. Thoroughly explain the eligibility requirements for VA aid and attendance benefits, discuss how these benefits might apply to the client's situation, and explore all other available long-term care funding options, including private insurance, before recommending any specific product. Explanation. This scenario is professionally challenging because it requires balancing a client's stated desire with the advisor's fiduciary duty to ensure the client understands all available options and potential consequences, particularly when those options involve government benefits with specific eligibility criteria. The advisor must navigate the complexities of VA benefits for long-term care without misrepresenting eligibility or encouraging actions that could jeopardize the client's access to these benefits. The correct approach involves thoroughly educating the client about the specific eligibility requirements for VA aid and attendance benefits, including the need for a service-connected disability or a pension based on need. It also requires exploring all available long-term care funding options, including private insurance, personal assets, and Medicaid, in addition to VA benefits. This comprehensive approach ensures the client makes an informed decision based on accurate information and their unique circumstances, fulfilling the advisor's ethical obligation to act in the client's best interest and comply with regulations regarding financial advice and government benefits. An incorrect approach would be to immediately recommend a specific long-term care insurance policy solely because the client expressed interest in it, without first exploring the potential for VA benefits. This fails to consider all available resources and could lead to the client purchasing an unnecessary or less advantageous product. Another incorrect approach is to advise the client to take actions that might artificially inflate their expenses or reduce their assets solely to qualify for VA benefits without a clear understanding of the long-term implications or the specific rules governing such actions. This could be construed as misleading or even fraudulent. Finally, simply stating that VA benefits are not an option without a detailed explanation of why, and without exploring other avenues, is a failure to provide adequate guidance and support. Professionals should approach such situations by first conducting a thorough needs assessment and financial review. They should then educate the client on all relevant benefit programs, including government benefits like VA and Medicaid, as well as private insurance options. The decision-making process should be collaborative, empowering the client to make informed choices based on a complete understanding of their options, eligibility, and the long-term financial implications of each path. Question 4. Process analysis reveals that a prospective client, concerned about future long-term care costs, is inquiring about how Medicaid might cover these expenses. The client has a moderate level of assets and a steady income. Which of the following strategies best aligns with the regulatory framework for Medicaid long-term care coverage in the United States, focusing on eligibility requirements, asset tests, income tests, and spend-down provisions? Option A. Inform the client that Medicaid coverage for long-term care is guaranteed once they require such services, regardless of their financial status, and that the program will cover all associated costs without any need for them to contribute from their income or assets. Option B. Advise the client that Medicaid eligibility for long-term care is primarily determined by the need for care, and that a detailed review of their specific asset holdings and income streams against state-specific Medicaid limits, including understanding how excess income is applied through the spend-down provision, is necessary to assess potential coverage. Option C. Recommend that the client immediately gift all non-essential assets to family members to reduce their countable assets below Medicaid's threshold, without discussing the implications of Medicaid's look-back period and potential penalties. Option D. Suggest that the client focus solely on their current income and disregard their asset holdings, as Medicaid's primary concern for long-term care is income level, and assets are generally not a significant factor in eligibility determination. The correct answer is B. Advise the client that Medicaid eligibility for long-term care is primarily determined by the need for care, and that a detailed review of their specific asset holdings and income streams against state-specific Medicaid limits, including understanding how excess income is applied through the spend-down provision, is necessary to assess potential coverage. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of Medicaid's complex eligibility rules, particularly concerning asset and income tests and the application of spend-down provisions. Advisors must navigate these rules accurately to provide sound guidance without misrepresenting coverage or creating false expectations. The primary ethical and regulatory imperative is to ensure clients receive accurate information about their potential eligibility for long-term care benefits under Medicaid, which is a needs-based program. The correct approach involves a thorough assessment of the client's financial situation against the specific asset and income limitations set by Medicaid in the relevant U.S. state. This includes understanding how different types of assets are treated, countable vs. exempt, and how income is calculated, as well as the mechanism of the spend-down provision, where excess income is used to cover medical expenses before Medicaid coverage begins. This approach aligns with the regulatory framework by adhering to the principles of accurate disclosure and client advocacy, ensuring the client understands the realistic pathways to accessing long-term care benefits. An incorrect approach that focuses solely on the client's desire for Medicaid coverage without a detailed financial assessment fails to acknowledge the stringent eligibility criteria. This is a regulatory failure because it bypasses the fundamental requirements of the program. Another incorrect approach that assumes all assets can be gifted or transferred to meet eligibility without considering look-back periods and penalties is a significant regulatory and ethical failure, as it can lead to disqualification and financial harm to the client. Furthermore, an approach that oversimplifies the spend-down process, suggesting it is a simple reduction of income without detailing the specific medical expenses that qualify, misinforms the client and can lead to disappointment and unmet needs. Professional decision-making in such situations requires a systematic process. First, identify the client's goals regarding long-term care and potential reliance on Medicaid. Second, gather comprehensive financial information, including all assets, income sources, and potential expenses. Third, consult the specific Medicaid regulations for the client's state of residence, paying close attention to current asset limits, income thresholds, and rules regarding asset transfers and spend-down. Fourth, explain these regulations clearly and accurately to the client, outlining potential eligibility, the steps involved, and any associated risks or limitations. Finally, document all advice and client communications thoroughly. Question 5. What factors determine the appropriate method for assessing a client's ability to perform activities of daily living, bathing, dressing, toileting, transferring, continence, eating, when applying for long-term care insurance benefits, considering both the client's stated preferences and the insurer's need for objective, verifiable evidence? Option A. A combination of direct observation, standardized assessment tools, and corroborating information from family or caregivers, ensuring the assessment aligns with the policy's specific definitions of functional impairment. Option B. Relying primarily on the client's verbal confirmation of their ability to perform each ADL, prioritizing their stated desire for independence. Option C. Utilizing a subjective assessment based on the professional's general impression of the client's overall well-being and perceived needs. Option D. Focusing solely on the client's emotional state and their expressed wishes regarding independence, regardless of their actual functional capabilities. Correct answer is A. A combination of direct observation, standardized assessment tools, and corroborating information from family or caregivers, ensuring the assessment aligns with the policy's specific definitions of functional impairment. Explanation. This scenario presents an ethical dilemma common in long-term care planning, specifically concerning the assessment of activities of daily living (ADL) for insurance benefit eligibility. The challenge lies in balancing the client's stated preferences and perceived capabilities with the objective criteria required by the insurance policy and regulatory guidelines. A CLTC professional must navigate potential cognitive biases, the client's desire for independence, and the insurer's need for verifiable evidence to ensure fair and compliant benefit distribution. The correct approach involves a comprehensive, objective assessment of the client's ability to perform each ADL independently, using standardized tools and seeking corroborating evidence where necessary. This aligns with the regulatory framework governing long-term care insurance, which mandates that benefits are paid based on documented functional impairment. The CLTC professional's ethical duty is to both advocate for the client's needs and adhere to the policy's terms and conditions, ensuring that claims are substantiated and that the client receives benefits they are legitimately entitled to under the policy's definitions of ADL impairment. This approach prioritizes accuracy, fairness, and compliance. An incorrect approach that relies solely on the client's self-reporting without independent verification fails to meet the objective standards required by insurance policies and regulatory bodies. This can lead to improper benefit payments, potentially resulting in claim denials later or even accusations of fraud. Another incorrect approach that focuses on the client's emotional desire for independence over their actual functional limitations overlooks the critical need for evidence-based assessment. While respecting a client's dignity is paramount, it cannot override the policy's requirements for demonstrating functional impairment. A third incorrect approach that involves pressuring the client to meet specific criteria, even if they don't genuinely meet them, is unethical and violates professional conduct. It undermines the client's autonomy and the integrity of the assessment process. Professionals should employ a structured decision-making process that includes 1. Thoroughly understanding the specific ADL definitions and benefit triggers outlined in the client's long-term care insurance policy. 2. Conducting a multifaceted assessment that includes direct observation, client interviews, and where appropriate and with client consent, consultation with family members or caregivers. 3. Utilizing validated assessment tools to objectively measure the client's ability to perform each ADL. 4. Documenting all findings meticulously, noting any discrepancies or areas requiring further investigation. 5. Communicating transparently with the client about the assessment process and the policy requirements. Question 6. Examination of the data shows a prospective client has contacted you, a certified long-term care (CLTC) professional, specifically requesting information and a proposal for a particular long-term care insurance policy they have heard about. They express a strong desire to move forward with this specific policy. What is the most appropriate initial step to take in providing comprehensive long-term care planning services? Option A. Explain that long-term care insurance is not a suitable option for them and suggest they focus solely on self-funding. Option B. Advise the client that you cannot discuss specific products until they have completed a lengthy questionnaire about their health history. Option C. Conduct a thorough assessment of the client's overall financial situation, health status, family circumstances, and long-term care goals before discussing any specific product. Option D. Immediately provide a proposal for the requested long-term care insurance policy, as the client has expressed a clear preference. The correct answer is C. Conduct a thorough assessment of the client's overall financial situation, health status, family circumstances, and long-term care goals before discussing any specific product. Explanation. This scenario is professionally challenging because it requires a CLTC professional to balance the client's stated preferences with their fiduciary duty to provide comprehensive and suitable long-term care planning advice. The client's desire for a specific product, without a thorough understanding of their overall needs, presents a conflict that must be navigated ethically and within regulatory guidelines. The CLTC professional must ensure that the advice provided is in the client's best interest, not driven by product sales. The correct approach involves a structured decision-making framework that prioritizes a thorough needs assessment before recommending any specific product or strategy. This approach begins with understanding the client's current financial situation, health status, family dynamics, and long-term care goals. It then involves educating the client on various long-term care financing options, including insurance, self-funding, and government programs, explaining the pros and cons of each in relation to their unique circumstances. Only after this comprehensive assessment and education can a suitable recommendation be made. This aligns with regulatory requirements that mandate suitability and a client-centric approach, ensuring that recommendations are appropriate for the client's objectives, financial situation, and risk tolerance. Ethical standards for financial professionals also demand a fiduciary duty, requiring them to act in the client's best interest above their own. An incorrect approach would be to immediately recommend the specific product the client inquired about without conducting a full needs assessment. This fails to uphold the fiduciary duty and regulatory requirement for suitability. It prioritizes a potential sale over the client's actual needs, potentially leading to an inappropriate or insufficient plan. Another incorrect approach would be to dismiss the client's inquiry outright and refuse to discuss any products. While caution is warranted, a complete refusal to engage with the client's stated interest, without first understanding the underlying reasons and assessing their broader needs, can be seen as a failure to provide comprehensive service and may alienate the client. A third incorrect approach would be to present a single product as the only viable solution without exploring alternatives. This limits the client's options and does not fulfill the obligation to provide a holistic view of long-term care planning. The professional decision-making process should involve 1. Active listening and information gathering to understand the client's stated needs and underlying concerns. 2. A comprehensive needs analysis covering financial, health, and personal factors. 3. Client education on a range of relevant long-term care planning strategies and products. 4. Collaborative development of a personalized long-term care plan. 5. Recommendation of suitable solutions based on the established plan, with clear explanations of why they are appropriate. Question 7. When evaluating marketing materials designed to promote CLTC expertise, which approach best aligns with regulatory compliance and ethical professional conduct? Option A. Emphasizing the CLTC designation as a mark of specialized knowledge in comprehensive long-term care planning, supported by educational standards and ethical commitments, while avoiding guarantees of specific financial outcomes or risk elimination. Option B. Presenting the CLTC designation as a comprehensive financial planning license that inherently covers all investment and insurance product recommendations, regardless of other required licenses. Option C. Featuring testimonials that highlight exceptional client outcomes and financial gains achieved through CLTC-advised strategies, without explicitly stating if these are typical or if compensation was involved. Option D. Using broad, aspirational language about achieving financial freedom and guaranteed security in retirement solely through the application of CLTC principles, without detailing specific services or qualifications. The correct answer is A. Emphasizing the CLTC designation as a mark of specialized knowledge in comprehensive long-term care planning, supported by educational standards and ethical commitments, while avoiding guarantees of specific financial outcomes or risk elimination. Explanation. This scenario presents a common challenge for CLTC professionals, balancing effective marketing with strict adherence to regulatory guidelines designed to protect consumers. The challenge lies in conveying the value and expertise of a CLTC designation without making misleading claims or engaging in prohibited practices. Professionals must demonstrate their specialized knowledge and commitment to long-term care planning while remaining transparent and compliant. The correct approach involves clearly and accurately representing the CLTC designation and the services offered, emphasizing the educational and ethical standards associated with it. This aligns with regulatory principles that prohibit deceptive advertising and require clear communication about professional qualifications. Specifically, regulations often mandate that marketing materials be truthful, not misleading, and avoid unsubstantiated claims of expertise or guaranteed outcomes. Highlighting the CLTC designations focus on comprehensive planning and client advocacy, while avoiding hyperbole is key. An incorrect approach would be to imply that holding the CLTC designation guarantees a specific financial return or eliminates all risks associated with long-term care. This is misleading because long-term care costs and outcomes are inherently uncertain and depend on numerous factors beyond the scope of any single certification. Such claims could violate regulations against misrepresentation and potentially lead to consumer confusion and financial harm. Another incorrect approach would be to use testimonials that are not representative of typical client experiences or that make unsubstantiated claims about the effectiveness of CLTC-backed planning. Regulations typically require testimonials to be genuine, verifiable, and not misleading. Failing to disclose any compensation received for testimonials or using overly enthusiastic, unrealistic endorsements would be a violation. A further incorrect approach would be to present the CLTC designation as a license to provide financial advice without also holding the necessary securities licenses or registrations. The CLTC designation signifies expertise in long-term care planning, but it does not automatically confer the authority to offer investment advice. Marketing materials must clearly delineate the scope of services and ensure all necessary licenses are in place for any financial advice provided, adhering to regulations governing financial professionals. Professionals should approach marketing by first understanding the specific advertising and marketing regulations applicable to their jurisdiction and professional licenses. They should focus on educating potential clients about the complexities of long-term care planning and how their CLTC expertise can help navigate these complexities. All marketing materials should be reviewed for accuracy, clarity, and compliance, ensuring they do not make promises that cannot be kept or misrepresent the value of the CLTC designation. Transparency about services, fees, and qualifications is paramount. Question 8. Quality control measures reveal that a certified long-term care (CLTC) professional has advised a client with 2 long-term care insurance policies to submit claims to the policy that offers the most comprehensive coverage first, regardless of the specific coordination of benefits language within each policy. What is the most appropriate course of action for the CLTC professional to take to rectify this situation and ensure future compliance? Option A. Instruct the client to contact the insurance department of their state to inquire about the correct procedure for coordinating benefits with multiple long-term care policies. Option B. Immediately review the coordination of benefits (COB) clauses in both long-term care policies to determine the correct order of benefit determination (OBD) and re-advise the client accordingly, ensuring all claims are processed according to the established rules. Option C. Advise the client to submit claims to both policies simultaneously and inform them that the insurers will resolve any coordination of benefits issues. Option D. Recommend that the client cancel the policy with the less comprehensive coverage to avoid any potential complications with coordination of benefits. The correct answer is B. Immediately review the coordination of benefits (COB) clauses in both long-term care policies to determine the correct order of benefit determination (OBD) and re-advise the client accordingly, ensuring all claims are processed according to the established rules. Explanation. This scenario presents a common implementation challenge in long-term care insurance where a client has multiple policies that may cover similar services. The professional challenge lies in accurately determining which policy is primary and which is secondary to ensure the client receives benefits without overpayment or denial, while adhering to the specific coordination of benefits (COB) provisions outlined in each policy and relevant state regulations. Misinterpreting these provisions can lead to significant financial implications for the client and potential regulatory scrutiny for the agent or insurer. The correct approach involves a thorough review of each policy's COB clause, paying close attention to the order of benefit determination (OBD) rules. These rules typically prioritize policies based on factors such as the type of coverage, the insured's enrollment status with an employer, or the order in which coverage was obtained. For example, a group long-term care policy might be primary over an individual policy, or a policy covering the insured as an employee might be primary over one covering them as a dependent. The agent must then apply these rules consistently to the client's specific situation, documenting the process and communicating the outcome clearly to the client and the involved insurers. This ensures compliance with the contractual terms of the policies and state insurance laws governing COB, preventing duplicate payments, and ensuring the client benefits from all available coverage. An incorrect approach would be to assume the policy with the higher benefit amount is always primary. This fails to recognize that COB rules are contractual and dictated by specific clauses, not simply by benefit levels. It can lead to incorrect primary/secondary designations, resulting in claim denials or overpayments. Another incorrect approach is to simply forward the claim to the insurer the client prefers. This disregards the established COB provisions and can lead to improper claim handling, potentially causing delays, denials, and disputes between insurers. It also fails to uphold the agent's responsibility to ensure accurate benefit application. A third incorrect approach is to advise the client to file the claim with both policies simultaneously and let the insurers sort it out. While insurers do have processes for resolving COB disputes, this approach places an undue burden on the client and can lead to significant delays in benefit payment. It also abdicates the agent's responsibility to proactively facilitate accurate claim processing based on the policy terms. The professional decision-making process for similar situations should begin with a comprehensive understanding of the client's existing insurance landscape. This involves obtaining copies of all relevant policies and carefully examining their respective COB provisions. The agent must then apply the established OBD rules, often referencing state insurance department guidance if ambiguities arise. Clear documentation of the COB determination and transparent communication with the client and all involved parties are crucial steps to ensure ethical and compliant claim handling. Question 9. The control framework reveals that a CLTC professional is advising a client with a progressive chronic illness. The client expresses a desire to maximize immediate tax benefits from a financial product, but the professional suspects this product may not adequately address the client's projected long-term care needs as their condition deteriorates. Which of the following approaches best aligns with the CLTC professional's ethical and regulatory obligations? Option A. Advise the client to delay any long-term care planning until their condition stabilizes to avoid making premature decisions. Option B. Prioritize a comprehensive assessment of the client's current and projected long-term care needs. Explore suitable funding options that balance immediate financial considerations with long-term security, and ensure the client fully understands the implications of their choices. Option C. Recommend a generic long-term care insurance policy without a detailed assessment of the client's specific chronic illness progression and future care requirements. Option D. Focus exclusively on the financial product that offers the most significant immediate tax advantages, as this is the client's stated primary objective. The correct answer is B. Prioritize a comprehensive assessment of the client's current and projected long-term care needs. Explore suitable funding options that balance immediate financial considerations with long-term security, and ensure the client fully understands the implications of their choices. Explanation. This scenario is professionally challenging because it requires balancing the client's immediate needs and desires with the long-term implications of their chronic illness and disability, all while adhering to specific regulatory requirements for long-term care planning. The CLTC professional must navigate complex ethical considerations, including client autonomy, informed consent, and the duty to provide advice that is in the client's best interest. Considering their evolving health status and financial capacity, the correct approach involves a comprehensive assessment of the client's current and projected needs, a thorough review of available financial resources, and the development of a personalized, flexible long-term care plan that aligns with regulatory guidelines and ethical best practices. This includes exploring various funding mechanisms, considering the impact of potential changes in health, and ensuring the client understands the implications of their decisions. This approach is correct because it prioritizes the client's well-being and financial security by proactively addressing the complexities of chronic illness and disability planning, in accordance with the principles of client-centered care and fiduciary responsibility inherent in CLTC practice. It also ensures compliance with any applicable state or federal regulations governing long-term care insurance and financial planning for such needs. An approach that focuses solely on immediate financial gains without adequately assessing the client's long-term care needs and potential future expenses is ethically flawed. It fails to uphold the duty of care and may lead to inadequate coverage or financial strain for the client down the line, violating the principle of acting in the client's best interest. Another incorrect approach would be to recommend a product or strategy that does not account for the progressive nature of chronic illnesses or disabilities. This could result in a plan that becomes insufficient as the client's needs increase, leading to unmet care requirements and potential financial hardship. This demonstrates a failure to provide comprehensive and forward-thinking advice. Furthermore, an approach that neglects to fully inform the client about the limitations, costs, and potential benefits of various long-term care planning options, including the specific regulatory requirements and consumer protection, is a significant ethical and regulatory failure. Informed consent is paramount, and clients must understand the choices they are making. The professional decision-making process for similar situations should involve a structured, client-centric methodology. This begins with a deep understanding of the client's current health status, prognosis, and personal preferences. It then requires a thorough analysis of their financial situation, including income, assets, and liabilities. The professional must then research and present a range of suitable long-term care planning strategies and products, clearly explaining the pros, cons, costs, and regulatory implications of each. Crucially, the professional must ensure the client fully understands this information and can make an informed decision. Regular review and adjustment of the plan are also essential, given the dynamic nature of chronic illnesses and disabilities. Question 10. Regulatory review indicates that a client who has recently experienced a significant decline in mobility and requires assistance with bathing, dressing, and meal preparation is expressing a strong preference for a residential setting that offers social activities and a sense of community, but is hesitant about the perceived level of medical care in a nursing home. Based on the regulatory framework for certified long-term care services, which of the following approaches best aligns with the client's needs and regulatory definitions? Option A. Recommend adult daycare, explaining that it provides social interaction and some assistance during the day, while not addressing the client's need for ongoing support with ADLs and residential care. Option B. Recommend nursing home care, emphasizing its regulatory compliance for providing comprehensive assistance with activities of daily living, adult, and skilled nursing, while also highlighting the social programs and community aspects available within such facilities. Option C. Recommend assisted living, focusing on the client's desire for independence and social engagement, and downplaying the regulatory limitations regarding the level of medical care and supervision typically provided. Option D. Recommend home health care, suggesting that a combination of in-home support services can meet the client's ADL needs and allow them to remain in their current residence, without fully assessing the client's need for constant supervision. Correct answer is B. Recommend nursing home care, emphasizing its regulatory compliance for providing comprehensive assistance with activities of daily living, adult, and skilled nursing, while also highlighting the social programs and community aspects available within such facilities. Explanation: this scenario is professionally challenging because it requires a CLTC professional to navigate the complex landscape of long-term care services while adhering strictly to the regulatory framework governing the certified long-term care designation. The core challenge lies in accurately identifying the most appropriate service type based on a client's evolving needs and the specific definitions and limitations prescribed by relevant regulations, without overstepping professional boundaries or misrepresenting available options. Careful judgment is required to ensure the client receives guidance that aligns with their current situation and the legal definitions of each service. The correct approach involves a thorough understanding of the client's stated needs and a precise mapping of those needs to the regulatory definitions of the available long-term care services. Specifically, it requires recognizing that, while a client may express a desire for a particular setting, the regulatory framework dictates the scope and purpose of each service. For instance, if a client requires skilled nursing care and assistance with multiple activities of daily living, adult, that cannot be adequately met in a less restrictive environment, then nursing home care is the only regulatory compliant option. This approach is correct because it prioritizes client safety and well-being by ensuring they are directed towards services that are legally defined to meet their level of need, as stipulated by the CLTC certification standards and any applicable state or federal regulations governing long-term care providers. An incorrect approach would be to recommend assisted living solely based on the client's preference for a more independent setting, even if their current needs, such as requiring 24/7 supervision or significant medical assistance, exceed the scope of services typically offered in assisted living facilities according to regulatory guidelines. This failure to align the service recommendation with the client's actual care requirements and the regulatory definitions of assisted living would be a significant ethical and regulatory breach, potentially leading to inadequate care and client harm. Another incorrect approach would be to suggest home health care for a client who requires constant supervision and assistance with all ADLs, as home health care is generally designed for intermittent skilled nursing or therapy services in the home, not for comprehensive, round-the-clock care. Recommending this would misrepresent the capabilities and regulatory scope of home health care, failing to meet the client's fundamental needs and potentially placing them at risk. Finally, recommending adult daycare as a primary solution for a client who requires full-time residential care and assistance with all ADLs would also be incorrect. Adult daycare is designed for social engagement and some therapeutic services during specific hours, not for the continuous care and supervision necessary for individuals with significant functional impairments. This would fail to address the client's core care needs and would be a misapplication of the service's regulatory purpose. The professional decision-making process for similar situations should involve a systematic evaluation of the client's needs against the regulatory definitions of each long-term care service. This includes 1. Active listening to understand the client's stated preferences and perceived needs. 2. Objective assessment of the client's functional status and medical requirements. 3. Cross-referencing these assessments with the specific regulatory definitions and scope of practice for each type of long-term care service: home health, assisted living, nursing home, adult daycare, hospice. 4. Communicating clearly and transparently with the client about which services are most appropriate based on their needs and regulatory compliance, explaining the rationale behind each recommendation. 5. Documenting the assessment and the basis for any recommendations made. Question 11. Risk assessment procedures indicate that a client residing in an assisted living facility is experiencing a decline in cognitive function and requires increasing levels of personal care. The client's family is concerned about the long-term financial sustainability of the care. Which of the following approaches best aligns with the CLTC professional's ethical and regulatory obligations in this situation? Option A. Immediately recommend the purchase of a specific long-term care insurance policy that offers the highest commission to the CLTC professional, assuming this policy will cover the client's current care costs. Option B. Advise the family to rely solely on Medicaid benefits without exploring the client's private assets or potential for long-term care insurance, as this is the most cost-effective solution. Option C. Conduct a comprehensive assessment of the client's current and projected care needs, financial resources, and personal preferences, and then develop a personalized, compliant long-term care funding plan that considers all available options, including private pay, long-term care insurance, and government benefits, while ensuring full disclosure and suitability. Option D. Urge the family to make immediate decisions about selling assets and transferring funds to cover care costs, without providing a detailed analysis of the long-term implications or exploring alternative funding strategies. The correct answer is C. Conduct a comprehensive assessment of the client's current and projected care needs, financial resources, and personal preferences, and then develop a personalized, compliant long-term care funding plan that considers all available options, including private pay, long-term care insurance, and government benefits, while ensuring full disclosure and suitability. Explanation. This scenario is professionally challenging because it requires balancing the client's immediate needs and preferences with the long-term financial implications and regulatory requirements of assisted living or nursing home care. The CLTC professional must navigate complex ethical considerations, including client autonomy, fiduciary duty, and the potential for undue influence or exploitation, all within the specific regulatory framework governing long-term care planning in the United States. The correct approach involves a comprehensive assessment of the client's current and projected care needs, financial resources, and personal preferences, followed by the development of a personalized, compliant long-term care plan. This plan must clearly outline how care will be funded, considering all available options such as private pay, long-term care insurance, and government benefits, while adhering to state and federal regulations regarding disclosure, suitability, and consumer protection. The CLTC professional's fiduciary duty mandates acting in the client's best interest, ensuring transparency, and avoiding conflicts of interest. This approach aligns with the ethical standards of the CLTC designation and the regulatory requirements for financial advice concerning long-term care. An incorrect approach that focuses solely on selling a specific long-term care insurance product without a thorough needs assessment fails to meet the client's best interests and may violate suitability regulations. This approach prioritizes product placement over client well-being and could lead to inadequate coverage or unaffordable premiums. Another incorrect approach that relies exclusively on government benefits without exploring all available private resources or insurance options may not fully address the client's potential long-term care costs, especially if their assets exceed certain thresholds, or if the benefits are insufficient for the desired level of care. This overlooks the comprehensive planning aspect required for long-term care. A third incorrect approach that involves pressuring the client into immediate decisions without allowing for adequate consideration of alternatives or consultation with family members or legal counsel undermines client autonomy and could lead to a plan that is not truly aligned with their wishes or financial capacity. This violates ethical principles of informed consent and can create future complications. Professionals should employ a structured decision-making process that begins with a thorough client discovery phase, including understanding their health status, financial situation, family dynamics, and personal goals. This is followed by an analysis of various long-term care funding strategies, ensuring compliance with all applicable regulations. The CLTC professional must then present a range of suitable options, clearly explaining the benefits, drawbacks, costs, and regulatory implications of each. The final decision should be the client's, made with full understanding and without undue influence. Question 12. The audit findings indicate that during a client meeting regarding long-term care planning, the client's adult children expressed significant concern about the financial implications of the client's preferred care options, suggesting alternative, less expensive choices that the client found unappealing. The CLTC professional is now considering how to proceed. Which of the following approaches best aligns with the ethical and regulatory framework for CLTC professionals in building relationships with clients and their families? Option A. Advise the client to make the decision independently of their children, without further engagement with the family to avoid potential conflict. Option B. Facilitate a discussion where the client's preferences are clearly articulated, and the CLTC professional educates both the client and the family on the benefits and drawbacks of various long-term care options, ultimately supporting the client's informed decision. Option C. Agree with the family's assessment of the financial risks and encourage the client to select the most cost-effective option, even if it does not align with the client's expressed desires for comfort and independence. Option D. Prioritize the family's financial concerns by strongly recommending the less expensive care options, emphasizing the need for fiscal responsibility to the client. The correct answer is B. Facilitate a discussion where the client's preferences are clearly articulated, and the CLTC professional educates both the client and the family on the benefits and drawbacks of various long-term care options, ultimately supporting the client's informed decision. Explanation. This scenario is professionally challenging because it requires navigating the delicate balance between a client's stated wishes and the potential for undue influence or a lack of full understanding, especially when family members are involved in the decision-making process for long-term care planning. The Certified Long-Term Care (CLTC) professional must uphold their ethical obligations to the client, while also acknowledging the legitimate concerns and involvement of family members who may be financially or emotionally invested. The core challenge lies in ensuring the client's autonomy and informed consent are paramount, even when faced with differing opinions or pressures from family. The correct approach involves actively listening to all parties, seeking to understand the underlying concerns of both the client and their family, and then facilitating a discussion that prioritizes the client's stated goals and preferences for long-term care. This approach aligns with ethical guidelines that emphasize client-centered advice and the importance of clear communication. Specifically, CLTC professionals are expected to act in the best interest of the client, which includes ensuring they fully comprehend their options and that their decisions are voluntary and informed. This often necessitates educating the family about the client's wishes and the available long-term care solutions, while gently reinforcing the client's ultimate authority in the decision. An incorrect approach that focuses solely on appeasing the family's financial concerns, without adequately addressing the client's expressed needs for independence and dignity, would be ethically unsound. This fails to uphold the principle of client autonomy and could lead to a plan that does not truly serve the client's best interests, potentially violating regulatory expectations for fiduciary duty and client-centered advice. Another incorrect approach that involves dismissing the family's input entirely, without attempting to understand their perspective or concerns, is also professionally problematic. While the client's wishes are primary, ignoring the family can create unnecessary conflict and may overlook valid practical considerations or potential future challenges that the client might not be fully anticipating. This can hinder effective long-term care planning and strain relationships. Finally, an approach that pressures the client into a decision that aligns with the family's immediate financial preferences, rather than the client's long-term well-being and preferences, is a significant ethical and regulatory failure. This constitutes undue influence and a breach of trust, as the CLTC professional's role is to advocate for the client's comprehensive needs, not to facilitate decisions based on external pressures or financial expediency that compromise the client's quality of life or autonomy. The professional decision-making process for similar situations should involve 1. Active listening to all stakeholders to gather information and understand perspectives. 2. Identifying the client's stated goals, preferences, and capacity for decision-making. 3. Assessing the family's concerns and their role in supporting the client. 4. Facilitating open and honest communication, educating all parties on long-term care options and their implications. 5. Prioritizing the client's autonomy and informed consent, ensuring they are the ultimate decision-maker. 6. Documenting all discussions and decisions thoroughly. Question 13. The evaluation methodology shows that a certified long-term care (CLTC) professional is advising a client on the tax advantages of a qualified long-term care insurance policy. Which of the following accurately reflects the tax treatment of premiums and benefits under U.S. federal tax law? Option A. Premiums are never deductible, but benefits received are always tax-free, regardless of the policy's qualification status. Option B. Premiums are deductible only if the policy is self-funded, and benefits are taxable if paid by a third-party insurer. Option C. All premiums paid for any type of long-term care insurance are fully deductible as business expenses, and all benefits received are taxable income. Option D. Premiums for qualified long-term care insurance are generally deductible as medical expenses, subject to age-based limitations, and benefits received for qualified long-term care services are generally received income tax-free. Correct answer is D. Premiums for qualified long-term care insurance are generally deductible as medical expenses, subject to age-based limitations, and benefits received for qualified long-term care services are generally received income tax-free. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a CLTC professional to accurately advise a client on the tax implications of long-term care insurance, specifically distinguishing between deductible premiums and tax-free benefits. Misinterpreting or miscommunicating these tax advantages can lead to significant financial detriment for the client and potential regulatory repercussions for the professional. The complexity arises from the nuanced rules surrounding qualified long-term care insurance contracts and the varying tax treatment of premiums and benefits, necessitating a precise understanding of IRS guidelines. Correct approach analysis. The correct approach involves clearly explaining that premiums for qualified long-term care insurance policies are generally considered deductible medical expenses, subject to age-based limitations set by the IRS. It also requires articulating that benefits received from such policies are typically received income tax-free, provided they are used to pay for qualified long-term care services. This aligns with Section 7702B of the Internal Revenue Code, which defines qualified long-term care services and contracts, and Section 105B of the Internal Revenue Code, which governs the taxability of accident and health insurance benefits. Accurate communication of these provisions ensures the client makes an informed decision based on the tax advantages available. Incorrect approaches analysis. One incorrect approach is to broadly state that all long-term care insurance premiums are tax-deductible without mentioning the age-based limitations. This is a regulatory failure as it omits a crucial condition for deductibility, potentially misleading the client into believing they can deduct the full premium regardless of age, which is not permissible under IRS regulations. Another incorrect approach is to suggest that all benefits received from long-term care insurance are taxable income. This is a significant ethical and regulatory failure because qualified long-term care insurance benefits are specifically designed to be received income tax-free under Section 105B of the Internal Revenue Code, provided they are used for qualified long-term care services. Misrepresenting this can lead to the client incorrectly calculating their tax liability. A third incorrect approach is to conflate the tax treatment of long-term care insurance with other types of insurance or general medical expenses without specific reference to the IRS code governing qualified long-term care contracts. This lack of specificity can lead to confusion and misapplication of tax rules, failing to provide the client with accurate guidance tailored to their specific insurance product. Professional reasoning. Professionals should adopt a systematic approach. First, identify the client's specific situation and the type of long-term care insurance being considered. Second, consult the most current IRS publications and regulations pertaining to qualified long-term care insurance, e.g., IRS Publication 502, Medical and Dental Expenses, and Section 7702B of the Internal Revenue Code. Third, clearly and accurately communicate the tax treatment of both premiums, including limitations and benefits, using plain language but referencing the underlying regulatory framework. Finally, advise the client to consult with their tax advisor for personalized tax advice, as the CLTC professional's role is to explain the general tax advantages, not to provide tax preparation services. Question 14. Research into the process of appealing a denied long-term care insurance claim reveals several potential strategies. A CLTC professional is assisting a client whose claim for in-home care services has been denied due to the insurer stating the client's condition does not meet the policy's definition of cognitive impairment. The professional has the denial letter, the client's policy contract, and the medical records submitted with the initial claim. Which of the following approaches is most appropriate for initiating the appeal process? Option A. Advise the client that the insurer's decision is final and there is no further recourse. Option B. Thoroughly review the policy's definition of cognitive impairment and the submitted medical records, and if necessary, obtain a detailed letter from the client's physician specifically addressing how the client's condition meets the policy's criteria, to be submitted as part of a formal appeal. Option C. Focus the appeal solely on the emotional distress the denial has caused the client and their family, emphasizing the urgent need for care. Option D. Immediately file a lawsuit against the insurance company, as the denial indicates a clear breach of contract. The correct answer is D. Immediately file a lawsuit against the insurance company, as the denial indicates a clear breach of contract. Explanation. This scenario is professionally challenging because it requires navigating the complex and often frustrating process of appealing a denied long-term care insurance claim. The CLTC professional must balance the client's immediate need for care with the insurer's contractual obligations and the regulatory framework governing claims handling. Careful judgment is required to ensure the appeal is robust, well-supported, and adheres to all applicable laws and guidelines, thereby protecting the client's rights and access to benefits. The correct approach involves a thorough review of the denial letter, the policy contract, and all relevant medical documentation to identify specific grounds for appeal. This includes understanding the policy's definitions of covered services and the criteria for medical necessity. The professional must then meticulously gather and present evidence that directly refutes the insurer's stated reasons for denial, often by obtaining additional medical opinions or clarifying existing records. This methodical and evidence-based strategy aligns with the ethical obligation to act in the client's best interest and comply with state insurance regulations that mandate fair claims handling and provide avenues for appeal. An incorrect approach that relies solely on the client's emotional distress or a general assertion that the denial is unfair, without specific factual or contractual support, fails to meet the burden of proof required for a successful appeal. This approach neglects the contractual nature of insurance and the regulatory requirement for substantiated claims. Another incorrect approach that involves immediately escalating to legal action without first exhausting the internal appeals process outlined by the insurer and state regulations is premature and potentially costly. While legal recourse is an option, it is typically a later step after other avenues have been explored. This bypasses established procedures designed to resolve disputes efficiently. A further incorrect approach that involves accepting the denial without further investigation or appeal, based on the assumption that the insurer's decision is final, abdicates the professional's responsibility to advocate for the client. This passive stance ignores the client's right to appeal and the potential for the denial to be overturned with proper evidence and procedure. The professional decision-making process for similar situations should begin with a comprehensive understanding of the client's policy and the reasons for the denial. This should be followed by a systematic review of all supporting documentation and relevant regulations. The professional must then formulate a strategic appeal plan, prioritizing evidence-based arguments and adhering to procedural requirements. Continuous communication with the client, and, if necessary with the insurer, is crucial throughout the process. Question 15. To address the challenge of ensuring accurate and compliant long-term care benefit approvals while maintaining efficient claims processing, which of the following strategies best aligns with the CLTC regulatory framework's emphasis on thorough assessment and documentation? Option A. approving claims based on a general understanding of long-term care needs without requiring specific documentation of medical necessity or the provider's credentials, assuming good faith from all parties. Option B, requesting extensive and redundant documentation from the claimant and provider upfront, even for minor claims, to minimize any potential for future issues, regardless of processing delays. Option C, expediting claim approvals based primarily on the claimant's stated needs and the provider's invoice, with a post-approval audit conducted only for a small percentage of claims. Option D, implementing a multi-stage review process where claims are initially screened for completeness, followed by a detailed assessment of medical necessity and provider qualifications by a qualified claims specialist, with all findings meticulously documented in the claim file. The correct answer is D, implementing a multi-stage review process where claims are initially screened for completeness, followed by a detailed assessment of medical necessity and provider qualifications by a qualified claims specialist, with all findings meticulously documented in the claim file. Explanation: the scenario presents a common challenge in long-term care insurance claims, balancing the need for timely benefit disbursement with the regulatory requirement for thorough and accurate assessment and documentation. The professional challenge lies in navigating the complexities of medical necessity, policy provisions, and the specific documentation required by the insurer, all while adhering to the Certified Long-Term Care (CLTC) regulatory framework. This requires careful judgment to ensure that claims are approved based on established criteria and that all necessary information is collected and verified to prevent fraud and ensure compliance. The correct approach involves a systematic review of all submitted documentation against the policy's definition of covered services and the claimant's assessed needs. This includes verifying the diagnosis, the prescribed care plan, the qualifications of the provider, and the necessity of the services for the claimant's condition. Regulatory justification stems from the CLTC framework's emphasis on consumer protection and fair claims practices, which mandate that insurers act in good faith, process claims promptly, and base decisions on objective evidence. Proper documentation is crucial for audit trails and to demonstrate compliance with state insurance regulations and the terms of the policy contract. An incorrect approach that relies solely on the claimant's self-reporting without independent verification of medical necessity or provider credentials fails to meet regulatory standards for due diligence. This can lead to improper payments and potential violations of regulations designed to prevent abuse of the system. Another incorrect approach, which involves delaying the claim indefinitely due to minor, easily rectifiable documentation gaps, violates the spirit of prompt claims processing and can negatively impact the claimant's access to essential care, potentially leading to regulatory scrutiny for unfair claims practices. Finally, an approach that approves claims based on a superficial review of documents, without a thorough assessment of whether the services align with the policy's coverage and the claimant's actual needs, risks approving benefits for services that are not medically necessary or are otherwise not covered, thereby undermining the integrity of the long-term care insurance system and potentially violating fiduciary duties. Professional decision-making in such situations requires a structured process. First, thoroughly understand the policy terms and the claimant's situation. Second, identify all required documentation as per the insurer's guidelines and regulatory requirements. Third, systematically collect and review this documentation, seeking clarification or additional information as needed. Fourth, assess the gathered information against established criteria for medical necessity and policy coverage. And fifth, make a well-documented decision to approve, deny, or request further information, communicating this clearly and promptly to all parties involved. Question 16. Analysis of a certified long-term care (CLTC) professional's responsibility when a prospective client who has been diagnosed with early-stage dementia expresses a clear preference for a specific in-home care service that the professional believes is not the most suitable option given the client's evolving needs and financial constraints. Which of the following represents the most appropriate course of action for the CLTC professional? Option A. Proceed with the client's preferred service without further assessment, assuming that any expressed preference overrides the need for a capacity evaluation due to the client's diagnosis. Option B. Rely solely on the input of the client's adult children who are present during the consultation to determine the most appropriate long-term care service as they are likely to have a better understanding of the client's needs. Option C. Immediately advise the client that their preferred service is inappropriate and steer them towards the options the professional deems more suitable, citing the client's diagnosis as a reason for limited decision-making ability. Option D. Conduct a comprehensive assessment of the client's decision-making capacity regarding long-term care choices. Provide clear and understandable information about all available options, including the client's preferred service and alternatives, and facilitate the client's decision based on their informed consent. The correct answer is D. Conduct a comprehensive assessment of the client's decision-making capacity regarding long-term care choices. Provide clear and understandable information about all available options, including the client's preferred service and alternatives, and facilitate the client's decision based on their informed consent. Explanation. This scenario is professionally challenging because it requires balancing the client's autonomy with the need to ensure they can make informed decisions about their long-term care needs. The CLTC professional must navigate the complexities of assessing decision-making capacity, which can fluctuate and be influenced by various factors, while respecting the client's right to self-determination. The core ethical and regulatory imperative is to protect the client's interests without unduly infringing upon their rights. The correct approach involves a thorough and ongoing assessment of the client's decision-making capacity, utilizing a multifaceted evaluation that considers their understanding of the information, their ability to appreciate the consequences of their choices, and their capacity to communicate a choice. This aligns with the ethical principles of autonomy and beneficence and regulatory frameworks that mandate informed consent. Specifically, the CLTC professional must ensure the client comprehends the nature of long-term care options, the associated costs, benefits, risks, and alternatives, and can articulate a reasoned decision. This process often involves using clear, simple language, providing information in various formats, and allowing ample time for questions and reflection. An incorrect approach would be to assume capacity based solely on the client's age or a general diagnosis, without a specific assessment. This violates the principle of respecting individual autonomy and can lead to decisions that do not align with the client's true wishes or best interests. Another incorrect approach is to override the client's stated preferences simply because the professional believes a different option is better, without a clear and documented determination that the client lacks the capacity to make that choice. This constitutes paternalism and undermines the client's right to self-determination. Finally, failing to involve family or other trusted individuals when appropriate, or conversely, relying solely on family input without direct client engagement, also represents a failure in best practice. The CLTC professional must facilitate the client's decision-making process, not dictate it. The professional decision-making process for similar situations should involve a systematic approach. First, clearly identify the decision to be made. Second, assess the client's capacity to make that specific decision, documenting the evaluation process and findings. Third, if capacity is present, facilitate informed consent by providing comprehensive, understandable information and allowing the client to make their choice. Fourth, if capacity is impaired, follow established legal and ethical protocols for surrogate decision-making, ensuring the client's previously expressed wishes or best interests are paramount. Question 17. The investigation demonstrates that a CLTC professional is assisting an elderly client with significant assets to establish a new annuity. The client, who lives alone and has limited contact with family, insists on naming a relatively new acquaintance as the sole beneficiary, despite the acquaintance having a history of financial instability. The client expresses a strong desire to proceed quickly and dismisses the professional's gentle inquiries about their understanding of the long-term implications and alternative beneficiary options. What is the most appropriate course of action for the CLTC professional to protect the vulnerable adult from potential abuse and exploitation while adhering to regulatory requirements? Option A. Advise the client that the transaction is too risky and refuse to proceed, suggesting they seek advice from a different financial advisor. Option B. Immediately cease all interaction with the client and report the situation to Adult Protective Services without further assessment. Option C. Proceed with the transaction as requested by the client, documenting their explicit instructions and understanding. Option D. Conduct a thorough, documented assessment of the client's capacity and the circumstances, seeking clarification and potentially involving trusted third parties with the client's consent before proceeding or reporting. The correct answer is C. Proceed with the transaction as requested by the client, documenting their explicit instructions and understanding. Explanation. This scenario is professionally challenging because it requires balancing the client's stated wishes with the potential for exploitation, a common ethical tightrope in long-term care planning. The CLTC professional must navigate the complex interplay of client autonomy, fiduciary duty, and the legal and ethical obligations to protect vulnerable adults. The specific regulatory framework for CLTC professionals in the U.S. mandates a proactive approach to identifying and reporting suspected abuse or exploitation, even when the client expresses a desire to proceed with a transaction that appears to be a result of undue influence or coercion. The correct approach involves a thorough, documented assessment of the client's capacity and the circumstances surrounding the transaction. This includes engaging in direct, uncoerced communication with the client, seeking clarification on their understanding and motivations, and consulting with trusted family members or legal counsel if appropriate and authorized by the client. This approach aligns with the CLTC Code of Ethics and relevant state laws that emphasize the protection of vulnerable adults from financial exploitation. Specifically, regulations often require professionals to act in the best interest of the client and to report any reasonable suspicion of abuse or exploitation to the appropriate authorities. This proactive stance, coupled with thorough documentation, safeguards the client and the professional. An incorrect approach would be to proceed with the transaction solely based on the client's immediate request without further investigation. This fails to uphold the professional's duty to protect the vulnerable adult, potentially enabling exploitation. Such an action could violate regulatory requirements that mandate due diligence and a heightened awareness of red flags for abuse. Another incorrect approach would be to immediately report the situation to authorities without first attempting to gather more information or assess the client's capacity directly. While reporting is crucial, an immediate, unsubstantiated report can damage relationships and may not be the most effective first step in protecting the client's interests, especially if the client has capacity and is making a legitimate, albeit perhaps unusual, decision. The professional's role is to investigate and assess, not to jump to conclusions or bypass the client's agency prematurely. The professional decision-making process for similar situations should involve a systematic evaluation. First, assess the client's cognitive capacity and understanding of the transaction. Second, identify any potential red flags for abuse or exploitation, such as unusual financial activity, isolation, or pressure from third parties. Third, engage in open and honest communication with the client, ensuring their consent is informed and voluntary. Fourth, document all interactions, assessments, and decisions meticulously. Finally, if reasonable suspicion of abuse or exploitation persists after these steps, consult with supervisors or legal counsel and make a report to the appropriate regulatory or law enforcement agencies as required by law and ethical guidelines. Question 18. During the evaluation of a resident's comprehensive care plan in a long-term care facility, a facility administrator requests a full copy of the plan for general oversight purposes. The care plan contains detailed medical history, treatment protocols, and personal care needs. Which of the following represents the most appropriate action to ensure compliance with HIPAA and privacy regulations? Option A. Grant the facility administrator full access to the care plan, assuming their position implies a need to know all resident information for effective management. Option B. Provide the facility administrator with a redacted version of the care plan, removing personally identifiable information, but retaining general care objectives and service types. Option C. Discuss the resident's specific medical conditions and care needs with the facility administrator in the facility's common dining area. Option D. Inform the facility administrator that access to the full care plan is restricted to direct care providers, and that their oversight role does not necessitate access to detailed PHI, offering to provide a summary of operational aspects if needed. The correct answer is B. Provide the facility administrator with a redacted version of the care plan, removing personally identifiable information, but retaining general care objectives and service types. Explanation. This scenario is professionally challenging because it requires balancing the need for comprehensive care planning with strict adherence to HIPAA privacy regulations. Long-term care facilities handle highly sensitive protected health information. 5. And any unauthorized disclosure can lead to significant legal penalties, reputational damage, and erosion of patient trust. The core of the challenge lies in ensuring that all individuals involved in a resident's care have access to necessary information without violating privacy rules. Careful judgment is required to identify who truly needs access to what information and to implement appropriate safeguards. The correct approach involves a thorough review of the resident's care plan by authorized personnel, specifically those directly involved in the resident's treatment and care, and ensuring that any discussion of PHI is limited to what is necessary for that care. This aligns with HIPAA minimum necessary standard, which mandates that covered entities limit the use or disclosure of PHI to the minimum necessary to accomplish the intended purpose. In this context, the facility administrator, while having a general oversight role, does not directly provide care and therefore does not inherently require access to the detailed PHI within the care plan for their daily duties. An incorrect approach would be to provide the facility administrator with a complete copy of the resident's care plan simply because they requested it for general oversight. This fails to adhere to the minimum necessary standard, as the administrator's role does not necessitate access to the detailed medical and personal information contained within the plan. This action constitutes an unauthorized disclosure of PHI under HIPAA. Another incorrect approach would be to discuss the resident's specific care needs and medical history in a public area of the facility, such as the dining room or a common lounge, even if the discussion is with a family member. This violates HIPAA privacy and security rules by failing to protect PHI from incidental disclosure to unauthorized individuals who may be present. A third incorrect approach would be to share the resident's care plan with a volunteer who assists with recreational activities, without first obtaining a business associate agreement (BA), or ensuring the volunteer is properly trained on HIPAA and has a legitimate need to know specific aspects of the plan relevant to their duties. This could lead to unauthorized access and disclosure of PHI, violating HIPAA. The professional decision-making process for similar situations should begin with identifying the purpose of accessing or disclosing PHI, then determine if the individual requesting access or disclosure is authorized under HIPAA, e.g., a healthcare provider involved in treatment, a patient themselves, or a party with patient authorization. If access is for treatment, payment, or healthcare operations, assess whether the disclosure adheres to the minimum necessary standard. Implement appropriate safeguards to protect PHI during any access or disclosure. If unsure, consult with the facility's privacy officer or legal counsel. Question 19. Cost-benefit analysis shows that while private long-term care insurance and personal savings are crucial components of individual preparedness, the escalating costs and increasing demand for long-term care services necessitate a broader societal response. Considering the current regulatory landscape in the United States that encourages a blend of private and public solutions, which of the following represents the most appropriate role for a CLTC professional in advising clients on addressing the long-term care crisis? Option A. Focus exclusively on the sale of private long-term care insurance policies, downplaying the availability or impact of government assistance programs. Option B. Advise clients to rely solely on Medicare and Medicaid for long-term care needs, as these programs are designed to cover all associated expenses. Option C. Emphasize a diversified strategy that integrates private insurance, personal savings, and an informed understanding of how existing government programs can supplement these efforts. Option D. Advocate for a complete government-funded universal long-term care insurance program, suggesting clients defer personal planning until such a system is fully implemented. The correct answer is C. Emphasize a diversified strategy that integrates private insurance, personal savings, and an informed understanding of how existing government programs can supplement these efforts. Explanation. This scenario is professionally challenging because it requires a CLTC professional to navigate the complex interplay between individual financial planning for long-term care and the broader societal implications of government intervention. The challenge lies in balancing the fiduciary duty to the client with an understanding of public policy and its impact on the long-term care landscape. A CLTC professional must consider not only the immediate financial needs of their client, but also the systemic issues that contribute to the long-term care crisis, such as affordability, access, and the sustainability of care. The correct approach involves advocating for and implementing comprehensive long-term care planning strategies that leverage a combination of private insurance, personal savings, and an informed understanding of available government programs. This aligns with the CLTC professional's ethical obligation to provide clients with the most suitable and effective solutions for their long-term care needs. It also reflects a responsible engagement with the regulatory framework, which often encourages a multifaceted approach to long-term care financing. By educating clients about the limitations and benefits of various options, including potential government support, the CLTC professional empowers them to make informed decisions that best protect their financial security and access to care. An approach that solely relies on private insurance without considering the role of government programs fails to acknowledge the existing public safety nets and potential subsidies that could supplement private solutions, potentially leading to overinsurance or inadequate coverage if government support is overlooked. Conversely, an approach that advocates for complete government takeover of long-term care financing, while seemingly addressing the crisis, disregards the established regulatory framework that promotes private market solutions and individual responsibility. This could lead to a misrepresentation of current policy and a failure to meet the client's immediate needs within the existing legal and financial structures. Furthermore, an approach that dismisses the need for any long-term care planning by assuming government will cover all costs is ethically unsound and exposes the client to significant financial risk, violating the CLTC professional's duty of care. The professional decision-making process for similar situations should involve a thorough assessment of the client's individual circumstances, risk tolerance, and financial capacity. This should be followed by a comprehensive review of available long-term care financing options, including private insurance products, saving strategies, and an accurate understanding of relevant federal and state government programs and their eligibility requirements. The CLTC professional must then present these options to the client in a clear, unbiased manner, facilitating an informed decision that aligns with the client's goals and the regulatory environment. Question 20. The audit findings indicate a CLTC professional advised a client seeking to qualify for Medicaid long-term care benefits to transfer their primary residence and a significant investment portfolio directly to their adult children. The client is concerned about preserving assets for their heirs, but also needs to access Medicaid benefits within the next 2 years. Which of the following approaches, if implemented, would have been the most compliant with Medicaid asset protection and eligibility requirements, assuming the client's intent was to protect assets while still qualifying for benefits within the specified timeframe? Option A. Recommend the client spend down all remaining assets on personal care services and home modifications that are not considered countable resources by Medicaid. Option B. Establish an irrevocable income-only trust (IIT) for the client's assets, with the client retaining the right to income from the trust for their lifetime, and ensure the trust is funded at least 5 years prior to applying for Medicaid. Option C. Advise the client to transfer all assets directly to their adult children immediately, as this is a common method of asset divestment. Option D. Suggest the client place all assets into a revocable living trust, as this removes them from the client's direct ownership. The correct answer is B. Establish an irrevocable income-only trust (IIT) for the client's assets, with the client retaining the right to income from the trust for their lifetime, and ensure the trust is funded at least 5 years prior to applying for Medicaid. Explanation. This scenario is professionally challenging because it requires navigating complex Medicaid eligibility rules, specifically the look-back period and asset transfer provisions, while also considering the client's intent to preserve assets for their family. The CLTC professional must balance the client's desire for asset protection with the strict regulatory requirements for Medicaid qualification. Misinterpreting these rules can lead to disqualification from benefits, significant financial hardship for the client, and potential professional liability. The correct approach involves establishing an irrevocable income-only trust (IIT) for the client's assets. This trust structure, when properly drafted and funded, allows the grantor, the client, to retain the right to receive income from the trust assets for their lifetime, while the principal is protected from being counted as a Medicaid resource. Crucially, the IIT is designed to avoid gift taxes, and when established and funded at least 5 years prior to applying for Medicaid, it satisfies the Medicaid look-back period, thereby avoiding transfer penalties. This approach aligns with the principles of responsible long-term care planning by providing a mechanism for asset preservation while adhering to federal and state Medicaid regulations. An incorrect approach would be to simply transfer assets directly to children or other family members without establishing a trust. This direct transfer is considered a gift and, if done within the Medicaid look-back period, typically 5 years, will result in a penalty period during which the applicant is ineligible for Medicaid benefits. This failure to account for the look-back period is a direct violation of Medicaid transfer of assets rules. Another incorrect approach would be to establish a revocable living trust. While revocable trusts are useful for estate planning and avoiding probate, the assets held within them are still considered owned by the grantor for Medicaid eligibility purposes. Therefore, a revocable trust does not protect assets from being counted towards the Medicaid resource limit, and it would not facilitate qualification for long-term care benefits. A third incorrect approach would be to advise the client to spend down all assets on non-allowable expenses or to purchase non-allowable assets that are not protected. Medicaid has specific rules about what constitutes an allowable spend-down. Simply depleting assets without proper planning or purchasing assets that are still countable resources will not lead to eligibility and may even create further complications. A professional decision-making process in such situations should begin with a thorough understanding of the client's financial situation, long-term care needs, and estate planning goals. This is followed by a comprehensive review of current federal and state Medicaid eligibility rules, including asset limits, income limits, the look-back period, and transfer of asset penalties. The CLTC professional must then identify and explain the available planning tools, such as EIT, that can achieve the client's objectives while complying with regulations. Transparency and clear communication with the client about the implications and requirements of each strategy are paramount.